Bank runs. When fear cracks banks. Imagine waking up on an ordinary morning to discover that your bank, the one where you've kept your life savings, might not open its doors tomorrow. No official crisis has been declared. No government announcements. Just a whisper, a street corner conversation, and the panic begins. During the 1930s in the United States, this scenario unfolded countless times. A simple whisper, "I heard the bank is going under," would send throngs surging toward the institutions. Desperate individuals clamored for every cent they had entrusted to the banks. Unbeknownst to them, their frenzied actions were inadvertently fueling the very catastrophe they sought to avert. These throngs were not wrong to fear. The banks of that era operated with minimal cash reserves. The majority of deposits were lent out or reinvested. In other words, there was no way to satisfy all clients simultaneously. It was akin to drawing the last card from a castle and watching it all crumble. The most curious thing? Many of these banks were healthy before the run began. They had assets, they had stability, but they had no defense against collective fear. What started as a rumor became reality, a self-fulfilling prophecy. This is the dark power of behavioral economics, where the value of money hinges more on trust than on tangible assets. And in this unseen game, fear is the most infectious virus. Today, we revisit this bygone era to comprehend how the panic of 1929 decimated institutions, families, and fortunes. And to inquire, are we truly insulated from another bank run? The history of money is underpinned by trust, not trust in the paper itself, nor in the numerical representations, but trust in the institutions that safeguard this currency. When this faith is shattered, the entire system begins to crumble, silently and violently. The Great Depression exposed this fragility in a brutal manner. What had appeared to be a bedrock of modern society, the banking system, proved vulnerable to something intangible: fear. The year was 1929. The United States was on the precipice of the most devastating economic downturn in its history. The stock market had crashed. Millions found themselves jobless, homeless, and bereft of hope. But the true devastation did not originate in the figures of Wall Street. It began on the sidewalks outside local banks. A mere whisper of doubts, a ripple of apprehension, a furtive glance was enough to send hundreds thronging to branch offices, clamoring for the return of their deposits. And in an era devoid of deposit insurance or government guarantees, losing money in the bank was tantamount to losing it forever. These bank runs were not organized. They were instinctive, impulsive, emotional, and precisely because of that, so devastating. The bank that served the community, that funded the farmer, the merchant, and the local family would collapse in a matter of hours, not due to mismanagement, but because it was unable to withstand the onslaught of simultaneous withdrawals. Between 1930 and 1933, over 9,000 banks collapsed in the United States. Thousands of families were driven into ruin. Decades of painstakingly accumulated savings evaporated. Panic spread with an unprecedented velocity, surpassing any previous crisis. The system, predicated upon stability, found itself cornered by its own inherent design, lending today's money with the guarantee of tomorrow's return. But when tomorrow became a question mark, the entire edifice crumbled. In this video, we'll delve into the origins of this phenomenon, exploring how collective fear shaped the American economy and the measures implemented to prevent a recurrence. For in the end, it was not thieves or wars that brought down the banks in 1929, but something far more insidious: the rumor that they might collapse. The dawn of collapse, how fear spread faster than the crisis. Prior to the collapse, the 1920s seemed a burgeoning American dream. The United States economy was surging, fueled by readily available credit, unbridled optimism, and a stock market that appeared limitless. Thousands, even from the working class, flocked to invest in the market. The prevalent mantra of the era was simple: invest today, be rich tomorrow. But what few realized or chose to ignore was that this prosperity was built on shaky foundations. Banks were handing out credit freely, and many investments were made with borrowed money. Speculation was mounting like an inflated bubble fueled by unrealistic expectations. And, as with all bubbles, it only took a single burst to initiate the implosion. That crackle arrived at the end of October 1929. In a matter of days, stock values plummeted. Panic-stricken investors began to sell everything. Fortunes vanished overnight. But the impact of the stock market crash was merely the first act. What followed would be even more devastating. With the financial market teetering on the brink of collapse, confidence in the banking system began to waver. The preponderance of American banks at the time were small, localized institutions, unaffiliated with a network shielded by federal regulation. Contrary to popular belief, these banks did not sequester all depositor funds within their vaults. The system operated on a foundation of trust. Banks would accept deposits and extend loans, retaining only a fraction of the total value in reserve. When whispers of banking instability first began to circulate, panic erupted like wildfire. A mere rumor was enough to trigger a bank run. Hundreds of people would throng outside branches, desperately attempting to withdraw their funds before it was too late. Ironically, this very stampede was what drove the banks towards collapse. Even financially sound institutions, boasting balanced ledgers, were unable to withstand the onslaught of simultaneous withdrawals. The first major wave of bank failures commenced in 1930, shortly after the stock market crash. Between January and December of that year, over 1,300 banks shuttered their operations. In numerous communities, the closure of a single bank left the entire populace vulnerable. Merchants found themselves unable to settle their debts with suppliers. Farmers were denied credit for planting, and entire families faced the devastating loss of their life savings. The domino effect was in full swing. It was more than just numbers. It was a human, psychological, daily crisis. Ordinary people who had never contemplated losing their meager savings found themselves in endless queues, desperate, fighting over coins, relying on rumors, and dreading the worst. Fear had supplanted logic, and, like a virus, it spread from town to town, infecting the entire nation. The domino effect and the collapse of trust. When the economy stalled, bank runs not only exposed the fragility of the financial system, but also brutally accelerated the decline of the American economy. When a bank failed, it wasn't just the building that closed, an entire ecosystem of credit evaporated. Small businesses crumbled for lack of working capital. Farmers couldn't finance the next harvest. Workers lost their savings, their jobs, and, in many cases, even their homes. What began as a financial collapse morphed into a societal disintegration. Unemployment surged, reaching an alarming 25% in 1933. Lines for soup kitchens became a ubiquitous sight in urban centers. Men who had once been pillars of their families now roamed the streets, desperate for any form of employment. Entire households were evicted, and children were compelled to abandon their education to contribute to the family's survival. The very fabric of American society was unraveling. Simultaneously, faith in the entire system was crumbling. If banks, the custodians of wealth, could collapse overnight, what else could possibly go wrong? Businesses ceased investing. Consumers refrained from purchasing. Money, instead of flowing freely, became sequestered, buried in backyards, or exchanged for tangible assets. The economy stalled, not due to a dearth of resources, but from an immobilizing wave of emotional paralysis. Faced with this maelstrom of financial turmoil, the American government was compelled to intervene. In 1933, the newly inaugurated President Franklin D. Roosevelt instituted a nationwide banking holiday, mandating the temporary closure of all financial institutions. The aim was to quell the panic and provide a window of opportunity for a carefully crafted institutional response. During this period, the government meticulously scrutinized the bank's financial statements, permitting only those in a sound financial position to resume operations. More significantly, it established the Federal Deposit Insurance Corporation, FDI, an agency tasked with guaranteeing bank deposits up to a predetermined amount. For the first time, citizens were assured that their funds would be protected, even in the event of a bank failure. This seemingly straightforward measure, the implementation of deposit insurance, proved instrumental in restoring public trust in the financial system. The psychological impact of this measure was immediate. People stopped rushing to the banks. Fear still lingered, but it was contained. From then on, a long process of reconstruction began. The bank runs of the 1930s imparted a crucial lesson to the world, that financial systems are, above all, social constructs predicated on trust. Possessing coffers and contracts is insufficient. Credibility must be cultivated. As we have witnessed, a mere fissure in this trust can cause the entire edifice to crumble. Collective panic lessons, what if it happened again? The bank runs of the Great Depression were not merely an economic event. They were a revealing window into human behavior in times of uncertainty. They demonstrated that, behind every financial system, there lies an invisible and vital component: trust. When that trust erodes, even the most robust figures cannot prevent a collapse. Decades have elapsed since that chaotic scene of queues snaking outside bank doors. Today, we have insurance, regulations, and central banks poised to intervene. But the lingering question remains: what if fear were to resurface? What if a digital crisis, a wave of fabricated news, or a systemic collapse rekindled panic, this time at the speed of the internet? We inhabit a world where information, whether voracious or mendacious, proliferates with unprecedented velocity. In 1929, a rumor might take hours to disseminate. In 2025, a single click suffices. The wisdom gleaned from past exigencies can safeguard us against future perils, provided we remain vigilant. The history of bank runs serves as a stark reminder. Securing vaults is insufficient. One must safeguard trust. This trust is built upon a foundation of transparency, stability, and, most importantly, memory. For those who forget the past, risk repeating its mistakes. If this video prompted you to reconsider the value of trust in the economy, share your thoughts in the comments below. Have you ever contemplated your reaction if your bank were to fail? Share your perspective. Subscribe to the Enriching World channel and continue exploring with us the remarkable narratives behind money, power, and the decisions that shape our world. See you in the next video.